Dark cloud cover, powerful bearish reversal signal. After a strong bullish rally, the market suddenly turns, but not with a crash, rather with a single, powerful warning candle. That's the dark cloud cover. A candlestick formation that warns traders the bulls are losing control and the bears are entering the scene. Today, we'll decode this powerful bearish reversal pattern, how to identify it, confirm it, and use it for profitable trades. Dark cloud cover, a smart trader's warning signal. The dark cloud cover is a two-candle pattern that appears after an uptrend. The first candle is bullish, showing strong upward momentum. The second candle opens above the previous day's high, creating optimism, but then it closes deep inside the previous bullish candle's body, signaling a shift from bullish to bearish sentiment. In simple terms, the second candle covers the previous day's light with darkness. Let's understand the psychology. The market opens with confidence, bulls push the price higher. But soon, sellers step in aggressively, dragging the price down. When the candle closes below the midpoint of the previous bullish body, it confirms buyers have lost control. This is where smart money quietly exits their long positions, and the bears prepare to attack. To ensure it's a true dark cloud cover, check these points carefully. Must appear after a clear uptrend. The second candle opens above the prior high, a gap up. The close of the second candle should be below the 50% mark of the first candle's body. Higher volume on the second candle strengthens the bearish signal. Smart traders never rely on a single signal. Combine this pattern with technical indicators for stronger confirmation. Stochastics, look for a bearish crossover in the overbought zone. Volume, a sudden rise on the bearish candle confirms institutional selling. EMA 5 or EMA 13, if the price starts closing below these, it confirms trend reversal. Here's a simple trading setup. Wait for the pattern to complete and the next candle to trade below the bearish candle's low. Enter a short position below that level. Keep your stop loss just above the high of the dark cloud cover. For targets, use support levels or previous swing lows. Never trade this pattern in a sideways market. It works best after a strong uptrend. Also, don't jump in before confirmation. Patience is profit. The body of the first candle is green, the body of the second candle is red. The uptrend has been evident for a good period. A long green candle appears at the top of the trend. The second day opens higher than the trading range of the prior day. The red candle closes more than halfway down the green candle. A dark cloud signal is not difficult to spot. Keep in mind the simple rules that establish a dark cloud signal. A gap up above the previous day's trading range, followed by a close well into the body of the last bullish candle, forms a signal that clearly indicates the uptrend is over. Dark cloud cover trading strategy. The most powerful bearish reversal setups, the dark cloud cover trading strategy combined with volume analysis, 5 and 13 EMA crossovers, and stochastic confirmation. This strategy works beautifully in identifying the end of a bullish trend and the beginning of a downward move with high accuracy. The dark cloud cover pattern is a two-candle formation that appears at the top of an uptrend. The first candle is bullish and long-bodied, showing strong buying pressure. The next day, the market gaps up open at resistance level, giving traders a sense of continued strength, but during the session, sellers started counter-attack and they take control, and the price closes more than halfway down into the body of the previous green candle. This sudden shift from bullish to bearish sentiment forms the dark cloud signal, a clear warning that buyers are losing grip. Now, to strengthen the setup, let's add a few technical confirmations. First, volume. The second candle, the bearish one, should form with higher than average volume. This rise in volume confirms that sellers are actively participating and dominating the session. Next, look for a negative crossover between the 5 and 13 EMA. When the 5 EMA crosses below the 13 EMA, it signals a short-term momentum shift from bullish to bearish, adding more conviction to our reversal setup. Finally, check the stochastic oscillator. Here, stochastic forms a negative crossover in the overbought zone where the %K line crosses below the %D line above the 80 level. This tells us that the market has been overbought, and a correction or reversal is likely to follow soon. Now let's talk about trade execution. Entry point: enter a short trade below the low of the bearish second candle after the pattern is confirmed. Stop loss: place your stop loss above the high of the dark cloud cover candle. Target: for short-term traders, aim for a 1:3 risk-to-reward ratio, or you can hold until the price touches the next support level or the EMAs flatten out. This confluence of signals gives a high probability setup for traders who prefer accuracy over guesswork. So next time you spot a dark cloud cover with these confirmations, don't ignore it. It's often the market's early warning that the bulls are stepping back and sellers are ready to take charge. If you found this strategy helpful, don't forget to like, subscribe, and share with your fellow traders. See you in the next video. Until then, trade smart, stay disciplined, and keep learning.